Options contracts are financial instruments that enable traders to buy or sell the underlying asset at a predetermined price. This can be done either before or at a specified date. Now, options have been used in a wide range of asset markets, such as equities and commodities, and have expanded into the cryptocurrency space as well. The purpose of using options trading is to hedge risks on existing positions or for pure speculation. We have increasingly seen that used. The general consensus is that it's used for pure speculation, but there is particular use for hedging risk and for hedge against your long or your other short positions. Now, while it sounds similar to futures contracts, the traders that buy options contracts are not obligated to settle their positions. And that is the main difference between them. So there's two main types of options. There's call options and put options. Call options allow traders to buy the underlying asset, and put options allow the contract owner to sell the underlying asset. Traders who would buy call options expecting that the underlying asset will rise in value, and put options are bought with the expectation that the price of the underlying asset will fall in value. Options are also categorized into American style and European style options, where American style options allow traders to exercise the contract at any time before and including on the expiration date. And then European style options allow traders to only exercise the contract on the expiration date. So you get a bit more freedom with the American style. It really depends on the exchange that you're using and what they are in particularly offering. So options are made up of four main parts. There's the size of the order or the number of contracts to be traded. The expiration date, the date that the contracts expire and the trader cannot exercise the option. We see the strike price. It's the price that the asset will be bought or sold if the contract holder exercises the option. And the premium, it's the trading price of the options contract, which indicates the amount an investor must pay to obtain the contract once created. The premium is constantly changing as the expiration date nears fruition. So here are some additional specifications we want to be aware of. What's the underlying asset, the contract size, the strike price, which is the exercise price. It's the price that traders can buy or sell the underlying asset when the options are exercised. The premium, the price that the trader acquires the options. We also want to be aware of the expiry date. When does this expire? When is the last day that the options are valid? And also the exercise style, whether or not they the dates on which the option may be exercised, either American or European. While buyers of options are able to choose when and if they exercise their call and put contracts, writers or sellers of the contracts are dependent on the buyer's action. Now, if a call option buyer exercises the contract, the writer or the seller must sell the underlying asset according to the contract. Now, if a put option buyer exercises the contract, the writer or the seller must buy the underlying asset according to the contract. Buyers have their losses limited to the premium paid to the contract, while writers are much more exposed to higher risk as it depends on the asset's market price at the time of execution. So there's a bit of balance between the creators of the contract or the person selling the contract and the buyer of the contract, whether it's a call or a put option. So it's definitely something to keep in mind of, and understanding what the scenario is. And it is a little bit more complicated than simply futures contracts, which is a much more direct agreement between buyer and seller. Here we see this option where the person, someone can write these contracts, write options, and they can write either call options where the buyer must agree to buy the asset, and then as a result, the seller or the writer has to sell that asset. And the writer can also sell put options, where the seller of the put option must buy the underlying asset, and the person buying the put option agrees to sell the asset. There's also premiums that we want to consider. The value of the premium is dependent on at least 4 main factors: the underlying asset's price, the strike price, the time left until contract expiration date, and general market volatility. Now, here are different scenarios where these premiums may increase or decrease. So if the underlying asset is increasing in price, we'll generally see call options premium increase. At the same time, we'll see put options premium decrease. It becomes much more incentive for to open up put options. But if the price continues to climb, when do you open up the price? That's when it becomes harder to assess. Higher strike prices. If the strike prices are generally increasing in the market, call options premium will decrease and put options premium will increase. Decreasing time, if the contracts are getting near expiration, we'll generally see call options and put options decrease in premium. And general market volatility will increase both the call options and put options premiums. Another factor to consider with options is the options Greek. Options Greeks are designed to measure some of the factors that affect the price of a contract. They are statistical values used to measure the risk of a contract based on underlying variables. The first one we'll talk about is delta. It's a measurement of the price of an options contract will change in relation to the underlying asset price. A delta of 0.5 indicates that the premium will move 50 cents or 0.50 for every $1 move in the underlying asset price. There's gamma. This measures the rate of change in delta over time. If delta changes from 0.5 to 0.35, then the gamma would be 0.15. Theta. This measures the price change in relation to a 1-day decrease in the contract's time. It indicates how much the premium is expected to change as the options contract gets closer to expiring. Vega measures the rate of change in contract price in relation to a 1% change in the implied volatility of the underlying asset. Increases in Vega normally reflect increases in the price of both calls and puts. Then there's Rho. Rho measures the expected price change in relation to fluctuations in interest rates. Increased interest rates generally cause an increase in calls and a decrease in puts. The value of Rho is positive for call options and negative for put options.